Hi, this is Randy Finney with the Right Side of the Chart, and today is Wednesday, January 9th, 2019. I wanted to get a video out for members, just kind of touch on some of the different things that I'm watching, not just broad markets, but look at gold, crude oil, the euro, US dollar, and maybe we'll hit on the broad markets or something I wanted to cover here today. Let's start out with gold. Gold continues to sort of just really trade around in a range recently. If you look, this is a daily chart we're looking at here, and you can see. So for a little while here, we're trading sideways. It may take the form. You could look at it this way of a potential bullish pennant. A pennant forms like this, similar to its cousin, a bull flag. But what I'm looking at here, and again, I closed out the swing trade. Remember, there's on the trade categories, I have separate categories for long-term trades, which are trend trades or investments, you can call them, and swing trades. And so the swing trade I closed out here at T2, revised that down just slightly below this former target. And T3 remains the long-term trade remains an active trade with that's the final target. So to me, it's more a matter of does gold have a decent pullback first, maybe even come all the way back down here and then thrust up there. You can see the PPO's pretty much at high level, starting to turn down. It hasn't crossed over yet, but we're up here pretty high levels. You can see these are the high level crossovers in the past, and you can just go ahead and look at the chart above and see what happened to price when you had those high level crossovers. So again, it doesn't mean that gold's going to go back down to lows. We had a high level crossover here, pretty decent correction from that, and then we made another thrust up, and of course that put in divergence. You can see the lower high here. So with gold, like the broad markets, it boils down to this, and I've had a lot of feedback lately on people like when I draw the arrows out, it's just a matter of short-term, my short-term outlook or very near-term outlook, intermediate and long-term. So longer term and even intermediate term, I remain bullish on gold. Near term, I still think there's a possibility for a pullback. However, I mentioned, was it Sunday night? I put up a post. I was considering adding this as an active short. Not at this time. I'm still holding off, and I probably won't do it. Here's why. Number one, we're going to get to the charts of the euro in a second, which look pretty good. But more so, the broad markets, a pullback is coming, a correction is coming. Whether we have a little more upside or not, it's going to be pretty decent, and therefore that normally, all other things being equal, will put a tailwind behind gold. In other words, that doesn't mean gold has to go up. It just means if it's charts or technicals look bearish, a tailwind, it means it may help the trade out, may hold it up even against bearish technicals, or maybe cause it to fall less than it might normally. Why? Because of the flight to safety. If we get a correction in the markets, that tends to lately, gold has been for a long time, they were ignoring it as such, but it has been once again a flight to safety instrument, as it has been historically. There's on-off connections with that flight to safety trade, but it has clearly been. And what happened is recently the markets started going back up and gold continued to go up. But you can see here again, as I mentioned, not to beat a dead horse, it hasn't gone up now for a couple weeks here. It's pretty much stalled out. It hasn't gone down, but it hasn't gone up much. And then bigger picture, again, one of the reasons I closed out the swing trade, this is a long term. This is the bear market downtrend line. This was the bull market back in 2011. I shouldn't even call it a bear market downtrend line. I've maintained a case that gold put in the bear market ended back here in late 2015, and we've been in a bull market since. It's really a very large sideways market for the most part, but you can see the trend has been mostly up, but we really have to break above this level right here because we have about equal highs. Once we do that, then we'll have a series of lower highs and higher highs, which is the definition of an uptrend in gold. But most importantly, again, just keep it simple for now. Resistance is resistance until unless taken out. So therefore, caution's in order. The PPO, which works well on all different time frames, is a trend indicator. That 9 EMA, the signal line, is still below the zero line, indicating a bearish trend, and it has been since here. We're coming off oversold levels, but we're getting close to overbought levels. So there it is. And again, if we pop above here, which I do expect sometime this year, we come up. My next target here is about the 130 level, and that's a big level. You got to expect a consolidation there, some type of reaction. But if and when we break above there, we can come all the way back up here at about 151. So this is my longer term outlook. This is talking 2019 and possibly into 2020 here, where I expect that all to happen. But near term, again, the risk reward just isn't very attractive right now, in my opinion, for gold. So enough on that, but it is worth spending a lot of time on. A lot of people trade it. Before we get to GDX, let me look at the euro. The euro US dollar is my preferred trading proxy because it's about over 60% of the dollar index is made up of the euro. So if you can chart where the euro US dollar pair is going, you know where the dollar is going. It's that simple. And this, keep in mind, when you look at the euro US dollar pair, it is the euro against the US dollar. So when this chart rises, it means the euro is rising against the dollar. It means the dollar is falling. When the dollar falls, that's bullish for gold. It's not magic. It's very simple. Gold, especially the gold we're trading here in the US or the ETF GLD, and typically around the world is priced in US dollars. You can price it in other currencies, but for the most part, it's usually priced in US dollars. Therefore, if the dollar weakens, it takes more dollars to buy an ounce of gold. So put supply and demand, free supply and demand. A falling dollar will cause the price of gold to go up. A rising dollar will cause the price of gold to drop. It's that simple. All right, so this is the long-term chart of the euro-US dollar pair. And this was a major bottom back here in 2017 with bullish divergences. It was highlighted at the time, as was this rising wedge pattern here with negative divergences. This is simple TA stuff. Wash, rinse, repeat. That divergent high led to a correction, brought us back to this support zone, which was really the top of that multi-year trading range or basing pattern in the euro-US dollar right there. You can see, so gold's fallen back to that with, you got it, bullish divergence in place. So my outlook for the euro US dollar is bullish. I think the euro will rise, especially as the whole Brexit thing finally gets cleared up and behind us. I think we'll see. The U.S. has ballooning deficits. A lot of countries do, but ours are pretty bad. And either way, the charts tell me that we now have a divergent low. So longer term, I'm looking at this. And again, if I am correct and the euro rises, or euro rises against the dollar falls, and again, that is bullish for gold. So there's my longer term case. Near term, we look at this. Today there was a pretty good move in the euro US dollar pair, pretty sharp punch up this morning if you look at the 1 minute charts, and that was you'll see gold tracked it penny to penny. I mean, you can overlay both 1 minute charts of gold futures and the euro US dollar pair, and you'll see that when the euro US dollar took off, gold immediately went up along with it. And so now where we're at resistance. I have a resistance line right here. It's not super well defined, but yeah, I've had it on here for a long time. A lot of reactions. Let me give you the level there. So we popped up to resistance around 115,439. And again, we had a divergent low here on the daily time frame as well. So that tells me that over time we're probably going up, and these are all potential targets. I haven't updated this chart in quite a while, but what we need to do here is break out of this range, this little basing pattern here, to get the next leg up. Now, the fact that we've hit resistance, as I always say, resistance is resistance until unless taken out. So maybe we pull back down, continue to consolidate here. I just don't have a strong opinion, so I'll just leave it at that. In the very near term, that is. Intermediate and longer term, I've already shared that. Here's GDX. Let's see, we have a couple different things here. Well, what I can do here is draw a trend line here. You can see somewhat of a trend line. Let's go to the 60-minute charts. No, let's go back to the daily. Sorry, I want to do that. This level here is a pretty key level. Flip back to a 2-day period. Here we go. Focus on this line. Let me color this line. I know these charts are busy. Look at that yellow. This 21-ish level is, to me, a huge level in GDX. Why? Because I just jumped back. This is 4 years we're looking at here. And you can see 1, 2, a whole bunch of trading around there. So 3, 4, look at all these reactions and look how well that level acted as support throughout 2017 and 2018. And not only did it once it was broken? Did we just limp through? No. The more significant and well-defined a support level is, the more technically significant it is, I should say, the more well-defined. And as such, this helps validate it. Once that level broke, you had a waterfall sell-off. That reaffirms that as a key level. And now we've come back up to it and tested it from below. And we've been testing that level, and we've yet to take it out with conviction. We popped above. Remember, you're going to see volatility in the minors, so they'll pop above and below a key level. But that's that. So that's one reason I closed the GDX trade just recently. Right around the third final target. Anyways, that's where that target was set there. Let's go back to the daily chart. And so you can see that level again, 60-minute chart. This is what I posted in the trading room today. Member asked for an update. I had this trend line here, and I said I'll remove this trend line now. I have this alternate trend line. Let's remove that uppermost trend line. This is the one I think is in play right now. We have quite a few reactions on it to help validate it, and this is where we closed out the the final the last final target on GDX recently was at 21.20. We had our first target all the way back here, second target here. I mentioned at the time we had divergence, so we're probably going to have to ride out a pullback, or you can book profits at T2 and recycle back in. The divergent high did play out. Came back down, but it never took out our stop, and then went on. So this was a trade, and again, a lesson I mentioned. There is a reason. Sometimes I will use Nugget and Dust as the official trade proxy, or for my own trading. But this is when you want to own Nugget, the 3-time leveraged ETF, or Dust. And this is when you do not want to own them. If you don't know what I'm talking about, go to the FAQ page on the site, go under ETF related questions and read. There's a question about decay. I give examples, and this is notorious. If of all the ETFs out there, there aren't many that have decay as bad as Nugget and Dust when you get caught in these sideways trading range, and that is just due to the day-to-day volatility, the back and forth swings. So if you were in GDX in this, you didn't suffer any decay. You held on. If you rode out the pullback on T2, fine. You made whatever you made from the point we entered, which is to the left of the chart somewhere, all the way up to the final target. That's what you made. In Nugget, you didn't make that. You would have lost. Well, let's just say you would have made that and then some because it's 3-time leverage, but you would not have done 300% of what GDX did because of all this leverage. So keep that in mind. And again, if you're not sure, read up on that FAQ page, and it'll explain how that decay works. Either for or against, you can actually work in your favor and give you better than 3 times the underlying index. So that's what I'm looking at, and basically the way this looks to me is a rising wedge pattern that certainly could extend. Now, if we take it out, that would be a little bullish. If GDX can get up above that level that I showed you on the daily chart, maybe it can run, but we do have some pretty significant divergences building. They haven't yet played out, and I mentioned in the trading room, in that update, there's some cross currents. I can see the PPO, which is again a great trend indicator, the 9 EMA, the signal line, which is the white dotted line. It's the last of the 2 to cross, and it works as a pretty good trend indicator. When it is above the 0 line, the trend is bullish, and you want to be long. When it's below, the trend is bearish. Now, some securities it works better than others. Very whippy things like GDX, you can get some whipsaw signals. And I also say this too. I've said this many times, but I know I have a lot of new people always coming into the site. I do not use trend indicators during choppy markets. You will get eaten to pieces. They don't work well. This is a choppy sideways market, so therefore you're going to get whipsaw signals. You're going to see that trend indicator flip above and below the 0 line, giving you buy and sell signals. You want to use it when you're trending, when you have a clear trend, and then you get a bearish crossover. That will help confirm it. Now, I don't trade just on that signal. I don't short when the dotted line goes above the 0 line. I don't go long every time it crosses over. I will use that in conjunction to either keep me in a trade or to give me a heads up on a impending trend change. But ideally, you want to use it with a trend line break. So for example, if GDX were to make an impulsive break below this uptrend line and then cross below there, that would help to confirm the sell signal. So that's how I use that. It's just a confirming signal. And the more buy and sell signals or indicators that you can line up in your favor, bullish or bearish for a trade, the better it is. But when I see conflicting evidence, like right now, I see divergence, but I always say divergence in itself is not a sell signal. And I also see the negative divergence right here, but I also see the PPO curling right back up on the zero line. And that zero line, not only does it do a great job at defining the trend, whether prices are above or below, but it does an incredible job of acting as support and resistance as well. You'll see a lot of when you're below, come back and hit it and then pull back down. And you can see a lot of tests right here, successful tests that kept the trend bullish. Okay, I'm going to talk fast, move fast to get this out because I want to cover a lot of things. And I do that because it helps me paint the big picture. I can sit there and for the general market analysis videos that I post on YouTube for the public or on the homepage of the site, that's broad market, but there's so many, the market, the financial markets are some of its parts. And the more things you can track, the better insight I think it can give you. So for example, these are Treasury bonds. And I said this recently, we had a long trade not too long ago on Treasuries when the market was falling. We were profiting on Treasury bonds. And then I said, I'm expecting a rally, and therefore you're going to see this flight to safety. I listed a few reasons, technical and fundamental, but one of those being the flight to safety risk bid would come out of the Treasury. So you can see, and I'm sorry if I didn't clarify this, guys, these are Treasury bond futures, ZB. So these are the long-term bonds. So this is the same really as TLT, if you will. These are long-term Treasury bonds like TLT. And so you can see as the market's been rallying recently, the flight to safety bid has deflated, meaning institutions are flocking, taking profits on their treasury, moving back out of treasuries into stocks. Therefore, they've gone down. And you can see it broke this trend line. I had some trend lines. I had a negative divergence, so it wasn't just a fundamental call, as I said, where I suspect Treasury bonds will fall because stocks are rising. It was also technically induced. And then we took out this uptrend line as well. But now, where we're at, and you guys know it's been a few days, it's a little frustrating. We're not moving up explosively anymore, but the markets had been creeping up. And what I'm seeing here now is a small bullish falling wedge with positive divergence. You can see it right there. I like to see my wedges confirm with divergence. In this case, it is. And we broke out today. I have to zoom in here for you. What does that mean? Well, it tells me that all of a sudden institutions, and remember, they're the smart money, they're moving back into treasuries right now. Is that a correction? They see what I see, I think they see what I think I see. It's a pullback in the market's coming. And so now we've had a breakout here that shows me money is moving back into treasuries right now. And yet the stock market was up, it is up as I'm doing the video, and it was up even more when I started the video. However, we're at resistance, so you can see there's a resistance line. We need to get above there. And if we do, there might be a quick trade on Treasury futures here. I wasn't prepared to give targets. I'd have to study this chart a little further. But let's say it might look something like this. Because remember, I'm not expecting a huge correction at this point. Maybe a pop and then a pullback, something along those lines. So there's just the near-term outlook for treasuries, I think. We've had a little pullback, a correction. I know some of you did buy TBT, which is a 2-time short treasury ETF. Maybe time to tighten up stops or take some profits, or even reverse that trade if you want to try to game a quick trade on the long side for treasuries. Next up, crude oil. This is CL. CL are the crude futures. Right there, and this is a 60-minute chart. Most of the charts on the futures I like to deal with are 60-minute charts. Every now and then I'll jump to a daily or a different time frame. CL, a story on that, and I posted again a chart in the trading room today on this. It has a pretty tight sideways trading range from November, about mid-November to mid-December down here, and then broke out of that range. So we consolidated for a while, and the bottom of that range should act as resistance, but we popped above it today. And the next resistance, I should add, there's a line about in the middle, and usually I do see this, whether it's a sideways trading range or a price channel. Very often I can draw a line in the middle of that price channel, or whether it's a sideways channel or an upward sloping or downward sloping, and you can see quite a few reactions along there. So these would be if we get more upside in crude, if it can hold this breakout, if you will, or this pop back into that range, then that would be your next target, and beyond that would be the top of the range, and that's pretty significant resistance there. However, we just had inventories released. That's why I waited to get to this one. They came out at 10:30 today. Looks like the crude got knocked down a little bit. It was up today and still up nice, 2.41%. Again, these are futures. They've been trading since before the market opened today, so that's not going to correlate with USO's gains. But you can see we pretty much came back. Let me tighten that up a little bit here for you. We came right back to that 50.46 line. I mentioned that in the trading room yesterday as well, being the bottom of that range there. And so if we fall back below, what this will be is a false breakout. And like I said, there's negative divergences that have been building on crude. We've come up quite a bit. We were very oversold. Let me just keep it simple. If we fall back down much below this 50.46 level, I think it'll be a failed breakout. We can probably give you a little bit, a little uptrend line right here to watch. There's a little wedge, and so I think a natural target would be that uptrend line right there. So to replicate that trend line, just come off the lows back here in December 25th or so, and I don't know why the oh, that's different down there. There's the dates right here, December 25th lows. There's your other reactions. Okay, and now the markets. Like I said, we were, since the December 24th lows, we're moving up impulsively. You can see these spurts here. This is impulsive buying, followed by periods of consolidation, some zigs and zags. There's a little correction there, and then another impulsive move. But in the last few days, we've just kind of been, you can see the trading range has really tightened up. We've been moving higher, and as I said, we've been diverging. We have, this was a support level or resistance level. It was taken out, but we're testing. We're dancing right on top of it today. And guys, I'm sorry if I didn't make mention. This is NQ, the Nasdaq 100 E-mini futures. But same story, and I've been highlighting this a lot lately, so I'm not going to harp on it too much. This is an uptrend line I think we're going to probably come back to soon. If not, at the very least, well, yeah, now it comes in again with that 64.10 level. That was a level we broke out recently. There's your divergences. Maybe they play out, maybe they don't. I think they will. More often than not, they do. That's all I can tell you. I can't give you any guarantees in trading, but I can tell you that 9 times out of 10, when you have confirmed divergence, probably better than 9 times out of 10, it's good for a correction. So this one has, we're not, we haven't really come back in yet, but we're not going up much higher. We're moving mostly sideways right now. But remember, there's still a voracious bid right now. This market is reinflating. Everything swung too far to the downside. And, although I'm focused heavily in the 60-minute charts, the daily charts were quite bullish recently. So, and I'm going to show you some upside targets here. IWM is coming up on just a golden target, potential shorting op, reversal points. Not there yet, but getting close. I'm going to get to that in a second. So let me cover, that was NQ. Let's see if I can find ES for you here. Same story. These charts look almost identical. They're trading very similar. There's some little support right about here. We're trading over. It was resistance, and so we need to pop down below that range. And same story. You have, if we get a pullback soon, this is what I'm looking at. This uptrend line and that 25, 22.50-ish level on ES would be my pullback target. So something like this, and then maybe another thrust higher. Here, I'm going to go out to the daily charts here, the ETFs. I'm just going to lead with IWM because this chart speaks volumes to me. If you remember, we had a trade here. I added it just before, during this meltdown part here before coming into Christmas, and they hit our stop, and I think a day after the stop was hit, the market bottomed. But I did make mention. Some people mentioned too that they gave it more rope and held on to it, because the stop was minimal. I think was less than 2% or something. We kept a real tight stop. So quite a few of you I know held on to it, and that was a good thing. And at the time, these were my price targets. You can see T1 has already been hit. Price targets I always set just below the actual resistance level. So that line is at 139.90, and you can see I set it a full point below just to be safe. And then here's my final target. I have it at 143.88, but the actual resistance line is at 143.96. Now, what I love about this, number one, by itself, that is pretty solid resistance. I'll show you what I'm looking at. You have a reaction high right here back in looks like late July, early August 2017. You have a reaction there. You have the reaction from that first drop back there in the February lows, and you have reactions here. And there's a little room there, I should say, too. Let's just call this, let me add a second line and tell you that would be more of a resistance zone because you have some reactions a little bit above there. That line I just put is at 145.70. So again, to simplify it, when I have two levels in close proximity, I call that a resistance zone, and that would be the resistance zone. Now, what's interesting is the first line that I had, and I had this as we're still going down as my bounce target here, this line at about 144. Look where the 38.2% Fibonacci retracement is. This is the 38.2 fib, and what that is, I measure from the highs right here, this high down to the low. That is a key Fibonacci retracement level. So you have a well-defined price resistance level coming in with the key 38.2% fib. So therefore, what I'm getting at is I see, minimal upside from today's highs. I'm grabbing today's high in IWM to that fib and that level there, 144. You're talking about 0.8%. I think it's a well-watched level. Maybe we get there. Maybe we blast through it. Anything's possible. But what I think will happen is the buyers will probably step in a little early. I'm sorry, the sellers. Those that have been long recently or those that are looking to short, I think that's an objective shorting op with a stop somewhat above the top of that range, maybe above 146. Again, depends on your price targets. Your stop allowance will have to be commensurate with your price target, usually using a 3-to-1 or better RR, risk reward ratio. So there it is. Just want to mention we're coming up on pretty decent resistance, little upside left before we get there, but remember there were a lot of trap longs on the way down, and there's a lot of quick gains that have been delivered to those that had the gumption to step in recently, so maybe they will step in and sell early. QQQ, I have Fibonacci clusters here. A Fibonacci cluster is when you take Fibonacci retracements from different points. So we had basically a virtually a double top in QQQ. So that's this yellow line of fibs right here. And then I had this reaction high I used. I had played around. You can put it here as well. There's another reaction high. I just don't have one. I didn't want to make this chart too busy. And I have this reaction high. So the purple line, the blue. And you can see right here, there's all three overlapping in very close proximity. I see a 38.2. I'd have to zoom in, and a 61.8. So right here, these three lines, I don't know if you can make them out in the YouTube video. It depends on your screen monitor, the contrast and all that, but because they're pretty subtle. But there's three Fibonacci retracements, so we call that a fib cluster. There's another cluster up here. I see two lines. These are kind of spaced apart, so this is probably our biggest cluster right here, and that's where QQQ is right now. At that fib cluster. And when we go here, I look at the price resistance. I have that 160, 32-ish level right there that I've been harping on for the last few days. We've really, have traded around that for days now, and that's also defined by a lot of reactions. So point is, this is where I think we're looking at a pretty good reversal, and I have to say this. This is possibly, I think there's probably going to be more upside. I'm leaning that way, but I am considering closing out for the first time since the market bottomed. I'm considering closing out some of the longs I've mentioned, going into IRAs and 401ks, scaling in, leading up to the week or so before Christmas, and expecting a bear market rally. But I may take some out of there, some off the table. I had about 75, 85, I think maybe 80, 85% net long exposure in equities, small mid-cap funds, U.S., international funds even. And, I don't think it's time to take everything out, but I may take some off the table. I'll try to communicate my thoughts there. But, my plan all along was to scale out the same way I scaled in. You can't nail the timing with a 401k because they're mutual funds. When you tell them to sell, whether you tell them at 8:30 in the morning before the market opens that day, or you tell them at 3:55 right before the market closes, you get the end of day closing prices. That's how mutual funds work, and that's what 401ks usually hold. Um, if you miss the cutoff that day, you're not going to get that closing price. It's going to wait until the following day's close. So you kind of have to look out ahead. And that was one reason too that I was scaling in, on the way down, because I knew once a bottom came, it would look like this right here. And so if you waited, let's just say, I was, walking around Epcot Center on the 26th in Orlando, but if you waited till the 26th and said, oh gosh, this is it, this is a real deal, it looks like a bottom's in, well, guess what? Even if you told them to put all your money back into stocks in your 401k right here at this point during the day, this is where they bought you in. And so therefore you basically didn't go anywhere. You went a little higher, but a few weeks later you were back where you started. And again, that's why I like scaling in on weakness and scaling out on strength, because if we get a reversal, who knows what it'll look like, but it could look like this, a big bang. All of a sudden something comes out, maybe some news-induced event, and we go way down. And at that point, you've just given back maybe, good part, if not all of your profits. So I'll be using that scale out method on the way up here. And again, I haven't decided yet. I want to watch today and may take a little off, nothing big. Okay, I think that's it. What did we hit on? Gold, currencies, oil, the broad markets. Yeah, that's enough for now. I'll try to, do some additional updates on the other trade ideas I posted recently. I still think there's more upside overall in the things like the home builders and the lumber stocks that I've covered, and the internet stocks I covered yesterday, and even the broad market in general. Again, at this point in time, I'm just looking for a pullback. Open to any possibilities. But I'm looking for a pullback and maybe a little consolidation, and most likely some more upside in the coming weeks here. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.